In this week's video, we'll review historical and present-day data to help us answer the question, does history say a 10% stock market correction is coming in the second half of 2019? The monthly non-farm payrolls report that was released on Friday, July 5th came in well above expectations. If we assume we were having a casual conversation on July 4th, we also assumed that at that time we did not know Friday's employment data and were asked to hypothesize the market's reaction to an extremely weak labor report and the market's reaction to an extremely strong labor report. If the labor report came in much, much worse than expected, we might expect silver and gold to lead. Long-term bonds such as TLT would most likely kill IEF, and all four of these relatively defensive assets would most likely outperform SPY and outperform SPY by a very wide margin. On the other end of the spectrum, if we assume the labor report was due to come in much better than expected, and the market was looking forward to a strong economy and a higher stock market, we would expect SPY to be our number one performer, intermediate term treasuries to most likely be number two, followed by TLT, gold, and silver. Thus, how did the market react on Friday, July 5th? Is it preparing for economic Armageddon, or is it looking forward to a stronger economy and higher stock market? How did these popular ETFs stack up after the June labor report was released on Friday morning, July 5th? Number one, by a wide margin, SPY down 0.18%. Number two, intermediate term treasury bonds, IEF, down 0.6%. Number three, defensive gold, significantly lagging SPY, down over 1%. Long-term treasury bonds down 1.33%, and silver down 1.82%. It's the relative performance of these ETFs. That's what matters relative to the market's reaction. SPY beat IEF by 3.5-fold relative to the loss. Stocks did 6.1 times better than the loss on GLD, 7.4 times better than TLT, and over 10 times better relative to the 1.8% loss on SLV relative to the muted and basically flat session in SPY with a loss of 0.18. It's very, very difficult to say that the market's reaction on Friday after the strong labor report is pointing towards economic Armageddon, and very, very difficult to say that relative performance doesn't lean towards the right-hand side of our screen. Obviously, we can't draw too many conclusions from one session. How about the entire week? A very, very similar story. July 4th week, SPY significantly outperformed TLT, IEF, GLD, and SLV. It's a big gap between gold, silver, and SPY in the holiday shortened week. This is a chart of the unemployment rate that we covered in detail in the June 7th, 2019 video. In that video, we covered the very weak labor report that was released in early June of this year and asked how concerning was it. You can see here the unemployment rate tends to spike when the odds of bad things happening economically and in the stock market increase. We get a big spike here and run up, and a big spike and run up here. On a relative basis, things didn't look that concerning on June 7th of this year. And in that June video, we basically said that the unemployment rate would have to spike somewhere in the range up to 4.09%, based on these historical examples here, for our concerns to increase significantly. We did get a small tick up in the unemployment rate on Friday, July 5th, but a very small move. It's at 3.7% relative to the chart that we covered in the June video. We're not even back to the lower Bollinger Band. When we covered that in early June, the lower Bollinger Band was at 3.76%. If we put the present day reading on this chart, we would be nowhere near the upper Bollinger Band, and we'd be somewhere in the neighborhood of the lower Bollinger Band, telling us based on the facts that we have in hand today. Not particularly alarming to see the small tick up in the unemployment rate. If we see a spike like this, or this, our concerns would increase. As we've noted many times in these videos, relative to our approach, we're not using any of this hard data to forecast anything. We're using this data to monitor the market and economy's present-day risk-reward ratio. We know the odds of a bear market increase significantly when the economy enters a recession, as it did in the shaded area here in 2001 and the shaded area here between 2007 and 2009. We can see in both cases the unemployment rate hits a bottom and then starts to rise relatively rapidly, a relatively significant move. Thus, in the present day, what we don't want to see is a sustained uptick and rise or spike in the unemployment rate. And we don't want to lose sight of the objective here. The objective relative to being a stock market bull is we want to avoid a recession. How we avoid the recession really doesn't matter. For example, in 1995, the unemployment rate started to tick up in a relatively concerning manner. The Fed cut rates here and cut rates here, and the economy was able to avoid a recession. You'll notice there's no shaded area on this chart here. After the strong labor report on Friday, July 5th, it's important for us to keep in mind there are basically three major economic data and Fed rate cut scenarios that we have to consider. Scenario number one, economic data improves without a rate cut and a recession is avoided. All things being equal, that would be bullish for both the economy and the stock market. Scenario number two, weak economic data leads to rate cuts and the stimulative impact enables the economic data to improve. And in this case also, a recession is avoided. All things being equal, that too, longer term would be bullish for the economy and the stock market. 1995, 1996 is an example where the economic data started to deteriorate. The Fed cut rates and the economic data started to improve, and the economy avoided a recession. Good things happen going forward in that case for both the economy and the stock market. Major scenario number three, weak economic data leads to a rate cut or rate cuts. The economy does not respond to the rate cuts. Economic data continues to weaken, leading to a recession. That would be similar to this scenario here where the unemployment rate spikes, or similar to this scenario here where the unemployment rate spikes. Thus far, based on the facts that we have in hand, and given that we're not anywhere near the center line or the upper Bollinger Band on this chart, and given there were broad employment gains in the Friday, July 5th labor report, probably fair to say the base case going forward until proven otherwise lies somewhere between scenario 1 and scenario 2. Obviously, that's subject to change, and that's why we always have to keep that flexible, unbiased, and open mind. I think it's also fair to say the initial reaction in the stock market on Friday when the S&P was down over 20 points tells us that we're still probably on the left side of this Fed effectiveness chart here. Nothing that we've seen since early January of this year points to being on the right side of this chart. That is also subject to change, but it hasn't changed yet. According to the CME Group, on July 1st, prior to the release of Friday's labor report, the market was pricing in basically a 100% probability of a Fed rate cut in the month of July, with about a 75% chance that it would be a 25 basis point cut, and some were still holding out hope that it would be a 50 basis point interest rate cut. It's a Barron's article that was also published on Market Watch after the labor report was released. You can read these little blurbs here from the article, but they basically make the case that not a whole lot changed relative to the bigger picture. We still have job gains that are slower relative to job growth in the first 6 months of 2018. And thus, during Friday's session and after the labor report was released, the market was still pricing in a 100% probability of a Fed rate cut in July. The change basically was that the probability of a big cut, a 50 basis point cut, dropped from roughly 26% to less than 4%. But the market is still expecting an interest rate cut. Could these probabilities be way, way off? Absolutely, positively, yes. And under our approach, how interest rates play a role or how they do not play a role going forward really doesn't matter. We're keeping our eye on the hard data. This scenario is still possible. This scenario is still possible. And if we see serious deterioration in the data, this scenario is absolutely positively possible as well. So the bond market did react to Friday's labor report, but it really just readjusted expectations relative to the probability of a 50 basis point cut, which is not particularly surprising when you take into consideration that the bond market was extended in a very rare manner at the end of May of this year. We covered that on June 4th. This basically says the bond market was most likely overextended and may have had unrealistic expectations about economic weakness and future Fed actions. And those expectations were dialed back fairly significantly on Friday, July 5th, but thus far it's more related to the magnitude of the first cut, not whether or not the Fed is going to ease. Again, that is subject to change. This portion of the slide and this portion of the slide basically come directly from Sentiment Trader. Here's the Twitter handle here. This information also said the bond market had probably overshot and overestimated what may or may not happen with the economic data and with the Fed. According to Sentiment Trader, bond optimism was extremely extended on June 27, 2019. And they stated, over the next 6 months, Treasury note futures showed a gain only once out of 9 times when you were extended like this, and risk over that time frame was more than 3 times reward, which is not something we often see, especially for a safe asset like bonds. Also from Sentiment Trader, among other notable signs of sentiment on bonds, global hedge fund managers have covered their shorts. RIDEX mutual fund traders are nearly the most bullish on record. That's the most bullish on record nearly relative to the bond market. Small speculators are the most exposed to the bond market in 18 years, and fund investors have piled into bonds over the past 6 months. All of this on June 27th of this year says we really shouldn't be shocked that the economic data came in better than expected, and we really shouldn't be shocked that the bond market had to make a relatively serious adjustment on July 5th relative to the probability of a 50 basis point cut. So to steal a term from Alan Greenspan, based on the data that we had in hand on June 27th of this year, and based on the data that we had in hand, data that was covered in this post, we can make an argument that the bond market might have been irrationally exuberant in recent weeks. And pessimism related to the stock market was also noticeable. This is from a Yahoo Finance article that you can find by Googling this title here where my cursor is. Basically said that fund managers were majorly underallocated or underweighted relative to the equity market in a way that we hadn't seen since the major low in 2011, the major low in the stock market. You can make an argument if they're underallocated stocks and we got a better than expected labor report, some of them might consider upping their allocations to equities. That's of course to be determined. But this chart here tells you it's not particularly surprising that the S&P 500 rallied intraday and finished well off the low on Friday, July 5th. Stock market sentiment. American Association of Individual Investors, bulls minus bears. Ryan Dietrich. We had seen bears greater than bulls for 7 consecutive weeks, the longest streak since February of 2016. You'll notice these type of readings are in the green range where good things tend to happen in the stock market. As Ryan notes, sentiment similar to what we saw in February of 2016. What happened next? Here's February of 2016, stock market sentiment similar to what we have in the present day. After the low in February of 2016, the S&P 500 rallied 58% between point A and point B. Over the same period, bonds and precious metals significantly underperformed stocks. TLT and IEF were both red. GLD and SLV were up, but these gains paled in comparison to the gains in the S&P 500. Simply telling us to keep an open mind about better than expected outcomes based on the facts that we have in hand today. Is there any other data, hard data, that we can measure right now in 2019 that also tells us to keep an open mind about better than expected outcomes in the stock market? The answer is yes. This chart here from Macro Charts, you can see the Twitter handle where my cursor is. Equity outflows are saying be open to significant upside in stocks. No forecast, just saying be open to it. How can that be? This shows you equity fund flows. It's a 12-month rolling sum. People are running for the exits. They're selling their equity funds in a very, very similar manner to this period here, this period here, this period here, and this period here. And in every case, this is the S&P 500, anecdotally, good things happened in the stock market. Good things happened in the stock market, and in a big way. And this often gets lost when we're covering historical studies. We do not make any decisions based on history. Present-day allocations are determined by present-day data and facts. History simply gives us some insight into the present-day data, present-day setups, and odds relative to history. For example, historical analogies told us that it wouldn't be unusual to see the stock market pull back between 4 and 10%. Thus, when we fell 6.58%, as covered in the May 31st video, that was still within the historical range or expected range. And that also aligned with the hard data that we covered in that video. Our allocations were based on this data, the hard data in the present day. The historical studies just helped us understand context. You can find the historical cases by Googling this title here and finding this short takes post dated May 28th, 2019. It's also interesting to note a big part of making good decisions is having realistic expectations. This 6.6% pullback here that occurred in the month of May, not particularly shocking when you consider that human psychology and trading activity and asset allocation decisions often result in a bottoming process. Way back on January 25th of this year, we said we should keep an open mind about some type of right shoulder-ish activity possibly taking place in the future. Let's shift gears now to this question from our buddy Ryan. His Twitter handle is here. The big question is, what tends to happen after a big start to the year for stocks? LPL Research. After the S&P 500 index returns 15% or greater as of the end of June. So you're basically saying really good things happen in the first half of the year. Typically, what happens in the second half of the year? So these are the years here on your screen that saw outstanding first half performance in the stock market. This shows you the return for the second half of the year, and this shows you the pullback or correction that occurred or drawdown that occurred in the second half of the year. Moral of the story, based on these cases here, the average gain in the second half of the year was basically 4.4%, the median 5%. Thus, muted expectations historically, and even more concerning, the average pullback in the second half of the year was 10%, and the median pullback was almost 8%. This is a good piece of research, it's relevant, and it's concerning. Therefore, we wanted to take a little bit deeper dive into these years here to see if there was anything that we could learn. So in each case, we're going to be looking at the charts as of mid-year or the end of June in the calendar year. This is the end of June, the last trading day in 2019. This is the last trading day of June in 1954, the first year in this table here. In the present day, the stock market's been going sideways for roughly 17 months. At the end of June 2019, the S&P 500 was 2.39% above this base that started forming 17 months ago. In the 1954 case, we also have a base and a breakout. But the difference is we're further away from the base. This is a little bit higher risk relative to this year. Still have a base relatively close by, but not as close as we have in the present day. Also noteworthy, if we look back 17 months, that's this point here, the S&P 500 at the end of June of this year was only 2.39% above where it was 17 months prior. It's a little bit different and more extended and more vulnerable in this case. If we look back 17 months, it's in this range in here somewhere. It's below this line. And instead of being 2% above the level, it's roughly 11%. The 1975 case, the first half of the year was excellent. But it's very, very hard to say that this setup in terms of investor psychology is similar to what we have in the present day. On June 30th, 1975, the market is still over 20% below the all-time high that was made early in 1973. We really can't expect investor psychology and fear to be the same here as it is here. In the present day, we just printed a new all-time high, which is quite a bit different than being 21% off the recent all-time high. 1976 is similar. You get off to a very, very good start in the first half of the year, hence why it appears in this table here. But there are some very significant differences between the present day and this point here. Once again, you're still over 13% below the all-time high that was made back in 1973, and now you're in 1976. And a very big difference. If we look back from this point here, 7 years, the stock market has gone up considerably. That's quite a bit different than this point here halfway through 1976. Even though the market got off to a very, very good start in the first half of the year, stocks have gone nowhere for basically 7 years. How about 1983? Unlike the present day, hard to make an argument that this isn't higher risk here than this point here. We're almost 20% above this breakout level here above the base. And maybe more importantly, in this case, if we look back 17 months to this point here, we're less than 3% above where we were 17 months ago. In this case, if we look back 17 months from midway through 1983, we're almost 40% above where we were looking back 17 months prior. It's very, very difficult to say that sentiment at this point here, investor psychology, cash on the sidelines, the desire to own defensive assets is similar in the present day relative to all of that here. When we look back 17 months, we're up almost 40% in this case. In this case, we've basically gone nowhere. I think it's pretty easy to make an argument halfway through 1983 is much riskier relative to a pullback than the present day. Similar situation, 1986, stock market gets off to a very good start, but that very good start is quite a bit different than the very good start that we're seeing in the present day. Today, we're less than 3% above where we were 17 months ago. In this case, we're over 45% above this base here and almost 40% above where we were 17 months ago, which is this point here. This is a much more extended market and more vulnerable to a pullback look than this look here. Thus, it's very, very difficult to make a direct comparison between this 6-month period and this 6-month period here. Similar situation, 1987. We're 43% above where we were 17 months ago, and we're almost 20% above this 6-month base here. This is a 6-month base, a breakout, and a rally. This is a 17-month base in the present day. Thus, it's very, very difficult to compare this 17-month period in investor psychology and everything that we've talked about. This A to B move is 17 months. This A to B move is 17 months. Some similarities, but some significant differences as well. 1995 is similar in one way. Our extension from the base, roughly 13%, is basically the extension looking back 17 months. So this point here is similar to this point here, and we do have a nice basing pattern in 1995, and we've got a nice basing pattern in the present day. The only difference is this is a little bit more extended from the base than we are in the present day. 1997, when we look backwards, we're 39% above where we were 17 months prior, and we're 30% extended from this relatively short base. This base here, depending upon how you look at it, is 4 to 7 months. We've got a 17-month base in the present day. We're not extended from the base, and in this case, we're 39% extended from a 4 to 7 month base. Again, very, very difficult to compare this 17-month period and this move to everything that's relevant in the present day, considering this 17-month move that is basically sideways. Very, very similar situation and story in 1998. It's very, very difficult to compare the risk halfway through 1998 to the risk halfway through calendar year 2019. Looking backwards 17 months, we were up over 40% on June 30th, 1998. This number compares to this number in the present day. 17 months in the present day, 17 months in 1998. Thus, to summarize, on June 30th, 2019, the S&P was 2.39% above a base that started 17 months ago. In these cases, 1954, 1983, 1986, 1987, 1995, 1997, and 1998, all of which appear in this table here, the average extension from the base, which is somewhat of your safety net, was 22%. The median extension from the base, so above the orange line, almost 20%. Quite a bit different relative to the 2.39% we have in the present day. And the 17-month look-back gain average was roughly 33%. Median, roughly 40%, again, significantly different relative to the 17-month look back in the present day. We didn't even include 1975 and 1976 because in this case, you were 20% plus below the all-time high. We just made an all-time high. Hard to compare psychology and cash levels and the desire to be defensive in this case. Same thing applies to 1976. Moral of the story: there are some significant and rare similarities between these years and the first half of 2019. But there are also some significant differences relative to the present-day risk-reward ratio relative to the risk-reward halfway through these calendar years here. Also noteworthy, 1954 and 1995 are the most similar to the present day. In this case, these are similar numbers in terms of being extended from the base and the gain looking back 17 months. Similar figures in 1954, consistent. Similar figures in 1995. Not the case here or in any of these cases here. Therefore, might be interesting to know what happened next in the stock market from June 30th, 1954 and June 30th, 1995. In the 1954 case, the S&P 500 eventually gained 70% between point A and point B. Also noteworthy and similar to the present day, big gains here in the stock market in the rearview mirror. A long-term period of consolidation, similar to what we have in the present day, and then a breakout to a new high, similar to what we have in the present day, telling us that investor psychology, cash on the sidelines, and the propensity to own defensive assets could be similar in this area here relative to the present day. Reinforcing there are some similarities between 1954 and 2019. How about 1995? 1995 also had a great first half of the year. From point A to point B, the S&P 500 gained an additional 180%. We also have some similarities to the present day in terms of sentiment, fear of a recession, and the topic of Fed rate cuts. Rearview mirror, we've got some big gains here in the S&P 500. Then we have a long-term period of consolidation and confusion, and then a breakout to a new all-time high. From this point here, after a really good first half in 1995, really good things happened in the stock market, simply telling us to keep an open mind about better than expected outcomes. Keeping in mind these 2 points here, is there anything else that's occurred recently that's relevant in the present day? The answer is yes. monthly NYSE advanced decline volume, which can give us some insight into what's going on at institutions. So this is our breadth reading here, a monthly chart. At the end of June, we had a close above the upper Bollinger Band, and that occurred after a long-term period of consolidation. How rare is that, and what happened next in the stock market in the historical cases that are similar to this look here? To answer that question, we went back and studied the historical cases where we see somewhat of a breadth spike here, similar to what we have in June of 2019. And this is the S&P 500 down here. We want to see this spike following some type of consolidation pattern in the S&P 500. And it's important to note, the consolidation can be a continuation pattern where we move higher after that, or it can be a reversal pattern or somewhat of a bottoming process. So we have something similar in October of 1982. NYSE advanced decline volume monthly closes above the upper Bollinger Band, similar to what we have in the present day. Price is moving sideways here for a long period of time in the S&P 500, similar to what we have in the present day. In both cases, the close above the upper Bollinger Band with the breadth indicator tells us that we're more than 2 standard deviations above the center line. We get a close NYSE advanced decline volume more than 2 standard deviations above the center line. That's relatively rare, especially in conjunction with a period of consolidation preceding that look. October 1982, somewhat similar. January 1985, somewhat similar. So in each case, this is your breadth indicator on the top, the S&P 500 on the bottom. April 1989, close above the upper Bollinger Band with our breadth indicator, somewhat of a sideways pattern, prices in the exact same place here in the S&P 500 as it is here. June 2019, S&P 500 sideways. We get the close above the upper Bollinger Band on the monthly NYSE advanced decline volume. Similar situation in March of 1991. Sideways, close above the upper Bollinger Band. Same thing in 1993. Somewhat of a sideways look in the S&P 500, and we get a close above the upper Bollinger Band. April of 1995, sideways action in the market, close above the upper Bollinger Band. December 1970, in this case we get somewhat of a troughing or bottoming look. The S&P 500 is in the same place here as it is here. S&P 500 is in the same place here, 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 and here. In both cases, we get the close above the upper Bollinger Band. March 1975, S&P 500 going sideways for several months, close above the upper Bollinger Band. April 1978, a similar look. May 2003, sideways action in the S&P 500, close above the upper Bollinger Band. This is similar to something that we can see in the present day. We didn't arbitrarily pick this historical study. May 2003 shares something with June of 2019 that's relatively rare. The same can be said for July of 2009. Somewhat of a troughing process in the S&P 500. Prices in the same place here as it was here. Close above the upper Bollinger Band. Sideways action, close above the upper Bollinger Band, March of 2013. Has some similar boxes that it can check relative to June of 2019. Thus, the million-dollar question is, in these historical cases, what happened next in the stock market from this point here which is similar to June 28, 2019, which was the last trading day of June? The answer is, on average, really good things happened in the stock market. Looking out 1 year, the average gain, roughly 13.6%, the median gain almost 14%, 92% of the 12 historical cases, the S&P 500 was higher. In 100% of the cases, the S&P 500 was higher 2 years later with an average gain of 26%, relatively consistent performance with a median gain of 24%. 3 years later, 100% of the cases green with an average gain of 37%, a median gain of 36%. 4 and 5 years later, 92% of the cases positive in this case, 92% of them positive in this case. Your average gain 54%, and here 74%. Is there any other way to differentiate these cases? The answer is yes. In this case, we might have a continuation pattern. We have a bullish trend, sideways action, and we break out to a new all-time high. We can see it better if we take a step back. A bullish trend, consolidation, and then we break out to a new all-time high. Therefore, if we saw a breadth thrust like this at this point here, that's not really similar to what we have in the present day. That's after big gains. What we have in the present day is this look here after a period of consolidation. So let's look at the historical cases where we have this similar thrust-like look in the breadth indicator, and let's differentiate them in this manner. Was the S&P 500 close to an all-time high when we had the close above the upper Bollinger Band? In these cases, the answer was no. In these cases, the answer was no. In this case, the answer was yes. Since investor psychology, cash on the sidelines, and the propensity to be defensive has a correlation to how long things have been uneasy, it's also relevant to look at how long the stock market went sideways. In the present day, the market went sideways for about 497 days, which is most similar to these cases here. 3,872 days is quite a bit different than 497, and the same can be said for the 1970 case, the 1975 case, the 2003 case, the 2009 case, and the 2013 case. Therefore, these cases here are the most similar to the present day. The basing period is more similar, and you're also near a new all-time high. Therefore, it might be helpful to know what happened next in these cases. The results were a little bit more hesitant and mixed looking out 30 to 90 days. But looking out 2 years, 3 years, 4 years, and 5 years, every single case was higher in the S&P 500, and the median gain ranged from 23% 2 years out to 77% looking out 5 years. This portion of the table here tells us to keep an open mind about better than expected outcomes. This portion of the table here tells us to keep an open mind about choppy action and givebacks, even if good things are to happen longer term. It wouldn't be shocking to see the market bounce around in an unconvincing manner or even post relatively tepid gains over the next year, helping us keep an open mind about all outcomes. And that's basically the same message that's being delivered here. Even if good things happen longer term, we should always have realistic expectations about what could happen shorter term. Looking at both ends of the spectrum, muted and bearish and much better than expected, helps us keep that all-important maximum flexibility going forward. Clients and regular viewers know that we looked at these bull-bear roadmaps way back on January 11th of this year. And remember, we said even in the bullish cases, it's not unusual to get movement inside of the moving averages, volatility, and even a scare where you drop below all of the moving averages. But in the long run, what these cases told us was, all things being equal, we would like to see price hold above the moving average cluster eventually, and all things being equal, we'd prefer to see the moving average cluster take on a look similar to this, or this. It's hard to make an argument that the same chart on July 5th, 2019, it's hard to say that it looks discernibly different relative to this chart, this chart, this chart, and this chart. Notice here, close below all of the moving averages in 2016. We came down to the bottom of the moving averages in 2019. We also noted several months ago that in the bullish cases, we would expect to see our trend strength scores improve significantly. And this is where the present day data comes into play. The present day data, forget all of the historical analogies. These are the facts that we have in front of us today from a trend perspective. These are the facts that we have in front of us today from a trend perspective. This helps us understand the net aggregate opinion of all market participants. And the net aggregate opinion of all market participants has the S&P 500 hovering near a new all-time high and has the S&P 500 staying above the 200-day moving average for the vast majority of the time since recapturing it in February of this year. Is it possible that this chart morphs into something that looks more like this, or this? Absolutely, positively, yes. But it hasn't happened yet. Our concerns would increase going forward if the present-day chart starts to morph into something more like this, or this, especially if we see some type of spike up in the unemployment rate. Our concerns would increase if this look reverses and drops back below the center line on a closing basis on this monthly chart. Our concerns would increase if price moves back into this area here. Our concerns would increase if the hard data that we have in hand starts to look like a situation where price is below all the moving averages and the slopes are down. And our concerns would increase if the market gets extended in a similar manner to this period here, this period here, this period here, this period here, and this period here. None of that has happened as of July 5th, 2019. But under our approach, it's extremely important to head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice and Shavacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.